Hi, welcome everyone to another episode of Let's Talk Special Economic Zones. I'm your host, Ainsley Brown, and in today's episode, we're going to talk about transfer pricing and special economic zones. And with this, because of the nature of zones, there are two dimensions that we have to explore. There is, in terms of transfer pricing and its connection to zones, one is international, one is local or domestic, because it has impacts on both, and the two can't be really separated. Now, let's define or explore what exactly transfer pricing is. Transfer pricing is basically, it's often, you know, multinationals are often accused of it, but it's not just about multinationals, it's about businesses shifting from one jurisdiction to another, particularly their profits or losses. They'll shift with the objective of lowering their tax burden. So they'll shift the profits from one jurisdiction to a lower tax jurisdiction, so they pay less or attempt to pay less taxes. And of course, we know that if it's done in a certain way, it can be either tax evasion or tax avoidance. Tax avoidance being fully lawful, but tax evasion being an unlawful act. Now, zones, because of their nature being separate yet a part of an economy, has some special features or in terms of in relation to transfer pricing. And we're seeing particularly these days with the whole OECD base erosion and profit shifting um, drive. This is what this is about. Um, and So that's again where the international dimension of things arises, right? So you have a situation where at the international level, a company, has its subsidiary located in a zone in another country, and then it shifts the profits or losses, depending on what it's doing, to lower its tax bill. Now, we know that with the OECD and the treaty that was signed, and then now coming into effect in 2023, that um, the avenue for that has decreased, because now there's a global minimum corporate income tax of 15%. So there's still, room to maneuver, but it's decreased, so to speak. So there's that one dimension. Now, in terms of the local, this is where things get, I think, even more interesting, is when a company has presence both in the domestic economy or local economy and the zone. And then they attempt to or do shift profits, etc., or do transfer pricing between the two companies. This is where there can be a bit of an issue um, for the tax authorities, and zones being, what you call preferential regimes, where certain fiscal incentives are offered, oftentimes a lower rate of corporate income tax. So let's say in the domestic territory, the regular economy, your corporate income tax is at 20%, but in the zone it's 10%. So a company may say, well, okay, I have a business that's in the zone, and then I subsidiary in the zone, and my headquarters is in the domestic territory. I'm going to see how best I can take advantage of that tax differential by shifting. And there are different mechanisms and means by which they do the shifting. Sometimes it can come in the form of intellectual property fees or management fees, um, that one company has to pay to the other. Typically, it's the subsidiary paying it to the parent company. Um, which in fact has a double effect, because what it does, it lowers, because those are expenses. um those are or you put the, sorry, I should say it this way: you put the intellectual property inside the in the SEZ company, and also the management fees are paid to the SEZ company. what that does, it lowers, those are expenses for the parent company. It then lowers what they have to pay to the government, because those are expenses, and you subtract that before you pay your taxes, of course. So that's one impact. The other impact, is it's a double impact, is then that, the overall, um, profits are, or what you pay tax is lower, because the SEZ company will be paying 10% on those economic activities, which technically they should have been carried out by the company that should have been paying 20%. So it's 10%. So, transfer pricing, can be, it's a very interesting area, and can be, represent a spot of bother, but there are often mechanisms, because governments recognize that this can be a lawful way of tax planning. They often create mechanisms whereby companies can enter agreements setting out the rules as to how the two companies will, cooperate, or how they work together. So the company in the zone and the company in the domestic territory. So the parent company, and then the subsidiary in the zone, and exactly how they work together and how things move. That's agreed to before with the tax authorities. And provided you follow the rules, everything generally should be okay. So if you like this episode, please like, share, and subscribe. If you want to see me do a particular subject, just leave me a message down below and I'll get right back to you.